Hi students, welcome to the video on Management Accounting at your fingertips. This is our video number 2. So in this video, we will focus on ratio analysis. We have already discussed ratios may be under traditional approach or modern approach. Under traditional approach, it may be balance sheet ratio. That means both the figure relates to balance sheet. Then profitability or income statement ratio. In this case, both the data are related to profit loss or income statement. That is, it belongs to either trading account or profit loss account. Then combo ratio means it takes into consideration both balance sheet item and income statement item or profit loss item. That means one belongs to profit loss or income statement, another belongs to balance sheet position statement. So in this ratio, we will solve one problem. So we already discussed liquidity ratio measures the short-term solvency and financial position of a firm. So comments of liquidity ratio is on short-term paying capacity of a concern or firm's ability to meet current obligations. Then solvency are total debt to outsiders or total asset ratio. Under solvency ratio, that is long-term solvency ratio, convey a firm's ability to meet the interest cost and repayment schedule and its long-term obligations. So under modern approach, it may be your liquidity ratio or solvency, leverage ratio, activity ratio and profitability ratio. So prepare a balance sheet or positional statement ratio from the following. Balance sheet of New India Limited as on 31st March 2021. So already you know, in case of company balance sheet, it is prepared in vertical form. First, equity and liability. Under equity liability, that is shareholders funds. Under shareholders fund, equity share capital was 10 lakh, preference share capital was 5 lakh. Then non-current liability, 8% debenture, that is fixed interest bearing investment by the debenture holder is 2 lakh. Long-term loan from any financial institution 1 lakh. Then current liability, it is defined in working note 1. Total is 1,65,000. Under current liability, first is trade payable. Trade payable includes both sundry creditor and bills payable. Here sundry creditor is 70,000, bills payable 60,000. So total is 1,30,000. Then bank overdraft 30,000, outstanding expenses 5,000. So total comes to 1,65,000. Then in case of then assets, non-current assets, it includes both tangible and intangible asset. Tangible means which can be seen and touched. Your fixed asset, land and building, plant and machinery, furniture, fixture, it is defined in working note 2. So under tangible assets is land and building 6,50,000, plant 8 lakh, furniture and fixture 1,50,000. So total is 16 lakhs. Then under intangible asset only goodwill is given 1 lakh. You know, goodwill is the reputation or fame of any business concern. When a business is running for a longer period of time, it gains its value, that is goodwill, that is 1 lakh. Then current asset is defined in working note 3, total is 2,65,000. It includes trade receivable, bills receivable and sundry creditor. Bills receivable is 70,000, sundry creditor 90,000. Total is 1,60,000. Then stock means inventory, closing stock is 30,000. Bank balance 45,000, short-term investment security 25,000, prepaid expenses 5,000. So we will discuss the various ratio. First is current ratio. All of you know current ratio is the relationship between current assets and current liability. One is current ratio is equal to current assets divided by current liabilities. So current assets is given here, total is 2,65,000 and current liability is given 1,65,000. So it is 265 by 165 or 53 by 33. So it is 53 by 33. This is 1, then 200, then 6. So it is 1.6. So the ratio is 1.6 is to 1. So ideal ratio is always 2 is to 1. That means the minimum the current assets should be twice of current liability in order to prove the short-term solvency of the organization of the firm. So firm is in liquid status, it is in a position to pay its short-term obligations. Then liquid ratio or acid test ratio. Liquid ratio or acid test ratio. It includes liquid assets by current liability. Liquid assets are those assets which can easily converted into cash within a short period of time. Liquid asset divided by current liabilities. In case of liquid asset, we have to deduct the inventory or stock and prepaid expenses. Then here the total is 2,65,000. From 2,65,000 we have to deduct inventory of 30,000, prepaid 5,000. So 35,000 will minus. So it will give us 2,30,000 divided by current liabilities 1,65,000. 46 by 33. So 46 by 33. Here it is 46 by 33. So this is first 1, then 33, then 13, 130 point, then 4. 1.4 is to 1. This is 1.4 is to 1. The ideal ratio is 1 is to 1. Ideal ratio is 1 is to 1. That means the liquid assets should be minimum, it should be equal to current liability. This is liquid ratio. Third one is absolute liquid ratio or cash ratio. Absolute liquid ratio or cash ratio. Or cash ratio. Here we will consider cash in hand, cash at bank. Cash in hand plus cash at bank plus investment in short-term security. Investment in short-term securities divided by current liability, divided by current liabilities. And the ideal ratio is 0.5:1. 0.5:1 is the ideal ratio or yardstick. That means the cash in hand, cash at bank plus investment short-term security should be minimum 50% of current liabilities. Here in this case, cash in hand, cash at bank total is 45,000. Then short-term investment in security is 25,000. So total comes to 70,000. So 70,000 divided by current liabilities 1,65,000. 1,65,000. So it is 70 by 165 or 14 by 33. 14 by 33. 14 by 33 means 0.140, then 480, then it is 2. So 0.42:1. So it is not sufficient. In this problem, the current ratio is more than 2:1 and liquid ratio is also 1:1, but ideal ratio is less than 0.5:1. Then we will consider debt equity ratio. Debt equity ratio. Means it is calculated in two ways. In first case, we will consider only long-term debt. Long-term debt divided by equity. Equity capital. That is equity. Equity includes, here in case of long-term debt is given 8% debenture 1 lakh, long-term loan 1,65,000. Then we will not consider current liability here. So we will consider 2 lakh plus 1 lakh, 3 lakh. Plus 1 lakh, that is 3 lakh long-term debt. Then equity capital, by equity, both it includes both equity share capital, preference share capital. 10 lakh plus 5 lakh. Then reserve surplus is not given, so it is 10 lakh plus 5 lakhs. So long-term debt is 3 lakh divided by 15 lakh. So it is 1/5 into 100, 20%. So here the debt equity minimum it should be equity, the long term debt should be minimum twice of the long term debts. That means the long term debt should be twice, minimum twice or thrice as per the norms policy of equity capital. That means suppose it is 15 lakh, then the organization firm can raise loan, long term debt up to the extent of 30 lakh if the at stake is 2:1, and 45 lakh if the at stake is 3:1. It depends on different category of borrower. So here it is very favorable because long-term debt, they are a very convenient position, means they will only 20% of the equity. In case of any liquidation of the organization of the company, they are in a favorable position to get their funds or get refund of their funds. Debt equity ratio. Then debt equity ratio here 20%. Then comes proprietary ratio. Another in this case debt equity ratio, that is total debt divided by equity, and the total debt to outsiders divided by equity. So this includes long-term debt plus current obligations, current liabilities or current obligations divided by equity. Here long-term debt is given 3 lakhs, then current liability is given 1,65,000 divided by 15 lakh. So it is 4,65,000 divided by 15 lakhs. So it is 93 by 300. That is 31 by 100. 0.31. It is also very favorable position because the long-term debt and current liability is of the investors, those who are given the long-term loan and who are from whom we have obtained the current liability, they are in a favorable position because the equity covers 15,000. That is, equity is heavy, so that in case of any difficulty or liquidation of the company, they are in a favorable position to get the refund of their money or investment. Then comes capital bearing ratio. Capital bearing ratios. In capital bearing ratio, first we will take equity share capital plus reserve and surplus divided by preference share capital plus long-term bearing fixed interest. Long-term bearing fixed interest. So in this case, equity capital is here. Equity capital here 10 lakh. Reserve surplus is not given, so it is 10 lakh divided by preference share capital is 5 lakh and 8% debenture is, that is long-term bearing fixed interest debenture, this is 2 lakh, so 7 lakh. 10 lakh by 7 lakh, it is 10 lakh divided by 7 lakh, that is 10:7. 10:7 or 1.4:1. In this case of capital bearing ratio, we have to calculate how much is the owner's equity. How owner's equity means here only equity share capital they are, but in case of fixed interest, preference share capital get fixed interest or fixed dividend on their investment, whereas equity shareholder are the owners of the company. If after meeting all the obligation, the profit is in a position to serve the equity shareholder, they will get their dividend. So first, the debenture holder will get the fixed rate of interest out of the profits of the company. Then after meeting the debenture holder, preference shareholder will be given their due share of dividend. After meeting both preference share capital plus long-term bearing fixed interest, how much is the net profit? That too will be distributed among equity shareholders. That is equity share capital plus reserve surplus. So here we can know out of total investment, the owner of the company is having here 1.4 and the preference shareholder and debenture holder, those who are getting fixed return, they are 1. So 1.4 is to 1. So it is very favorable position for the debenture holders, because the equity shareholder, when equity shareholder covers the major portion of the capital, then it is beneficial for the investor. In case of any difficulty or liquidation of the company, they are in a favorable position to get the return of their investment. Then another is proprietary ratio. Under proprietary ratio, it is equity divided by total assets. Total assets. Here, in case of equities, that is 15 lakhs. 10 lakh plus 5 lakh. 15 lakhs divided by total asset is 19 lakh 65,000. So this is 300, then 393, 100 by 131. This is the ratio. 100 is to 131. So this is all about this problem. In the next class, we will solve some activity ratios and profitability ratio. Thank you for watching this video. Don't forget to share this video to your friends or relatives so that everybody will be benefited, and you should like and subscribe the video.